Hello, and welcome to the GX Rystad joint webinar. Our topic for discussion today is the changing dynamic of the Middle East refined products market. Joining me on this webinar is Mr. Mukesh Sahdev, Senior Vice President, Global Head Commodities Markets at Rystad, and Anh Duy, Energy Analyst at General Index. Hi, Mukesh. Jumping straight into the Middle East market, we start with crude first. With the supplies expected now to come back from this month and additionally more supplies coming back from the month of May, what does this actually mean for the crude markets in the near term?
Well, good to be here, Aabha and Duy, and I think doing this session, I love the title, Refined Products Market, because I believe the product market has the answer to the crude market. Sometimes we focus too much on the crude market. But let's look at some of the fundamentals and the big macro picture. And I guess that if you look at the overall demand side of the equation, what you really see is this picture. The most important thing is to watch out for March to August. 2025 is not a normal year. In a normal year, when we look at year-on-year demand growth numbers, it makes sense. Now, when people look at 2025 like a normal year, everybody thinks about demand growth, decent, 1 million barrels per day, supply growth, about 2 million barrels per day, of which non-OPEC is a big part, and OPEC is trying to show an opportunistic move to bring some barrels to the market in the May boost. So Aabha, I would call this is an opportunistic May boost because if we really look at March to August evolution on the rightmost chart, we clearly have the demand growth. Refineries would be hungry for crude oil when they come out of the turnaround and run to meet the summer demand. I would say that we are not in energy security time. I would say we are in energy anxiety times, right? And this really means that whether the demand side, the tariff side impacts the demand side, the refineries would come hungry for crude oil. And we are also having April and May as the maintenance months in Canada and Norway. So there is a lot happening. And that's why we believe OPEC Plus has done an opportunistic move to give a little bit of the May boost.
That's very interesting. And before we jump into today's, topic of session, and we'll come back to some of the slides that I've skipped, the other interesting thing that's been in the market is the negative EFS spread, the Brent Dubai EFS spread. Of course, it has come back up now. Partially, this has been a factor of, the European refineries were in maintenance. The demand in general was a little bit weaker. But now, with the turnaround season ending, the increased supplies coming back, also quite timely to say that the OSPs have also come out now, and they've been quite competitive. What does this? Where does this leave the medium sour grade in this entire complex of things?
So I would say let's look at the quality. Crude has a quality problem versus a volume problem, right? I think we have too much of the light barrels hitting the market. We had the OPEC Plus cutting the medium sour barrels, but then we also landed into the heavy sour problem with Mexico, situation on water. Then we have the Venezuela situation, which is very precarious if the Chevron license is not extended. And then it can fall to below, around 600,000 barrels per day. We have a Canada situation with also sort of a looming. So I would say that the medium SAR market, because of the heavy SAR challenge, is also going to stay supported, whereas the light kind of the market is still, I would say, has a lot more oil, available. So we have seen the tightness in the Dubai, with the Dubai backwardation actually lifting up. Whereas the WTI and the Brent time spreads have actually gone in the opposite direction. So I would say that despite the OPEC Plus adding, I would say, just another 230 sort of kilo barrels per day and taking the growth to the 400,000 barrels per day is not a lot when we look at March to August. So I would say Dubai will stay supported. Yes, some strength might come in Brent as turnaround happens and refineries come back. But we're still looking at a strong Dubai, despite, I would say, the Saudis sort of slashing the OSPs much higher than the expectations.
Correct. And I think in the midst of all this is also the fact that the Iranian supplies also continue to remain tight in the whole medium sour complex as well, along with Venezuela and other supplies as well. So definitely very interesting there as well. So thanks, Mukesh, for sharing those insights. I'm going to bring in Andwi into the conversation. Andwi, over to you.
Thanks, Aabha. I'm Mukesh. So let's move on to today's topic. As you can see, the Middle East refining landscape has changed considerably over the past 3 to 4 years. So, for example, like the start of new refineries such as Aljo and Rukum refineries, the upgrade of Ruaris refineries, and then we also have the ongoing expansion of the Baku. So from this, what does this mean at a macro level for the refined products market in the region first, domestically?
Now, I think an excellent picture to look at, and I would say almost last March, I remember we had done the analysis and we had looked at what I call oil circularity sort of in the Middle East. I call downstream is the new upstream with a question mark. And as you can see on these slides, literally China was the engine for refinery capacity growth. But a lot of the investments that took place in the Middle East came out after the COVID times, and we have seen a strong, refining sector growth. This simply means that the product market is becoming a big tool in the hands of the Middle Eastern crude producers. And you can see that is very much visible on the product export side, where China is probably reducing, Middle Eastern product exports are really increasing. Now, this means that we have been calling that the OPEC Plus was driving the car, the market car with one pedal of crude. Now they have the second and a robust second pedal. And it is not just that the refineries have come in the Middle East. The Middle Eastern players have taken significant stake in outside Middle East, in Korea, in China, and other places. So I would say this simply means the growing importance to balance the revenue. If you lose in crude oil because you have to cut, you balance by bringing products to the market. And maybe another important point is that OPEC Plus has learned from history that if you gun for higher forever, you get lower for longer very fast. So stable oil price is a very important thing. And by putting products back to the market, they can provide a ceiling to a spike in oil price so that the refineries are not hungry outside. And I think the bigger game in my mind is that through this mechanism, the OPEC Plus and the Middle Eastern producers are going to target the non-OPEC refiners, buyers of non-OPEC crude oil, and put a back pressure on the non-OPEC crude buyers. So instead of going into a price war, which does not help anyone, they will likely go into a refinery margin war, and refineries and product export is the tool to do it.
Thanks, Mukesh, for the thought. Okay, so as we touch on a bit about export, so let's look further down into the supply chain. So as seen on the recent reports and ship tracking data, last year, around 4.6 to 5 million barrels of refined products were seen being exported out from the Middle East. So based on that, what kind of impact are you seeing in the wider market?
I would say that if you really look at margins are gone. Ukraine crisis gave the world another, let's say, a little golden age of refining with cracks touching to $40-60 a barrel of the main products. What we are witnessing now is that the Middle Eastern refiners have claimed that price and taken good the European shorts as well. Now, also, I would say not just the product market, as I was mentioning, that we have a crude quality problem, whereas the North American crude exports have really gone high. And while you look at these charts are index charts because we are having a webcast with the journal index sort of. So what we really look at is the U.S. exports have really grown very high, whereas the exports from other countries are gone down. Now, the light sweet barrel is not the right kind of the barrel, and refineries look for, especially when they want to make the main fuels. We were hoping that petrochemical market will take a bit more turn around and upswing in 25 and then in 26. But then all these tariffs also doesn't give a good picture. So overall, I feel that the petrochemical complex was hoping to lift some refinery margins, and I think that is also evaporating.
Oh, that's very interesting, like focusing on petchem. Anyway, thanks for that, Mukesh. So let's take a step out of the Middle East region and looking at some of the other capacity expansion that have and are taking place. Let's zoom into India. So we are seeing significant refinery expansions like the IOC, Panipat, and Barauni refineries for Hindustan Petroleum Vijay upgrade, and their Barmer refinery is expected to start later this year. However, even ahead of all this expansion, the average export of the refined products from India to Europe from around the period of 2020 to 24 remained well above 430 kilobarrels per day. So in this expansion landscape, you see Middle East refiners maintain the market share. Okay.
Excellent question. Both of these refineries, I worked for long years at Panipat and Barauni as well. I started the Panipat refinery, was part of the team once. So I would say that, yes, we have to take a little bit pinch of salt. These are aspirational. These are ambitious products, projects going forward. What I would say is that China is orienting itself towards more of the petrochemical side. They are closing refiners, teapots are closing. They are shifting a big Dalian refinery out of the urban landscape. So China's contribution into the Singapore market probably will go down from a product exports angle. And that's how I believe there is ample room for the Middle Eastern and the Indian refiners to push products into the market. Also, because the Europe is getting the long crude, the light barrels, right? Europe is not getting the medium sour barrels. Europe is also having a demand sort of a situation. So all in all, I believe that the east to west trade flows of products is something to watch for.
Thanks, Mukesh. I'm just going to jump in here. This is very interesting in terms of this trade flow. So, right now, fair to say that the Middle East products are also finding homes in Europe, refined products in Europe. The Indians are also going to be heading that way. So, that seems to be the home for all these middle distillate products that are sort of being pumped out from the refineries as part of upgrades and even ongoing, refineries that are running right now. Then.
No, indeed, I would say that Middle East has the best of both worlds. The Middle Eastern refineries are designed for the winter grade diesel for European market. So they are targeting the diesel and the jet molecules towards the Europe. And Middle Eastern refiners send a lot of LPG, naphthas, not just from the refineries, from the gas processing plants, and also some of the fuel oil to the Asian system. Now, with the Trump and China, US-China tariffs, we see that the petrochemical feedstocks will come in a crossfire because China is heavily dependent on propane and ethane and kind of imports from the US side of the market. So I guess this again gives the Middle Eastern refineries a good opportunity to land their light end molecules into the Chinese petrochemical system. I think the big question we need to think about is if these tariffs last longer than the summer, then we may have a problem. But till that time, I believe there is a good opportunity for Middle Eastern refiners. Now, this brings a high sulfur fuel oil challenge because Middle Eastern refiners, I know many refineries I visited, and I know that the fuel oil, they were making 30% fuel oil. Now, a lot of these refiners are consuming the oil. And after the IMO 2020, it's no longer a high sulfur fuel oil game. It's a very low sulfur fuel oil game. And the Brazilian barrels have become, the medium sweet barrels have become very important. So if you look at this chart, clearly the high sulfur fuel oil market has gone down. But as the simple refineries struggle and the margins are poor in Europe, I guess there will be tightness in the high sulfur fuel oil market to come. And I think getting those barrels, for example, Russia was sending a lot of the VGO and the residue feedstocks for the US refiners. So if you have Mexico challenge, which can't make fuel oil, you don't have the Russian residues for the US system, you don't have the Canadian exact volumes. Overall, we may face a residue sort of a shortage problem, which will keep on lifting and supporting some of the high sulfur fuel oil market.
Thanks, Mukesh and Aabha, for this question. So just continue on since we touched on fuel oil. So actually, in the early March, after Trump announced the plan to impose 25% tariff on Mexican and Canadian oil, reports were saying that Mexican refiners were looking to divert their high sulfur fuel oil export to Asian buyers, which is like last month. And with that, it could have competed with the Middle Eastern barrels. But since right now, oil and gas are exempted from the US tariff, but from there, I want to ask the what if question, like hypothetically, if the tariff had been imposed and flowed to Asia, did actually happen, what would the Middle Eastern refiner would have done to retain their Asian customer while ensuring their high sulfur margin remain favorable for the sales?
Well, I think the Middle Eastern refiners and OPEC is playing one good, I would say, strategy where by pumping more products to the market, the margins stay weaker, and a lot of the simple refineries cannot stay and sustain operation and business unless the governments give them then some oxygen support, right? So that tightens the high sulfur fuel oil market for sure, which gives support. Now, as far as Mexico is concerned, I think Mexico is quite an uncertain situation. We have looked at the Mexico supply side, crude oil side production analysis in great detail, and we have found out those water issues, the salt issues are not easy to solve. So Mexico will struggle to generate production. Mexico refineries who took the oil, I think the view is that they have solved the problem, but probably they have not solved the problem. So I would say that let's not pitch a lot of hope on what comes out of Mexico.
All right, thanks for that, Mukesh. That's very interesting. As it's somewhat quite new to me that I've not seen. I did not realize about the spec of the Mexican fuel oil having the water, having the salt inside. That's hard to process in Asia. Okay, so let's move on to the next topic. So it's incomplete. So for this presentation, it's quite incomplete to talk about the Middle East region without focusing on the energy transitions. So with the global rise in the electric vehicle adoption or the EV, the Middle East is still currently at its early stage, but we could see the exponential growth, like similar to the China, South Asia, Europe, and the US. And also many reports have shown that China gasoline demand would peak between 2025 to 2027. And while it's still uncertain when the Middle East will reach its own peak for the fuel gas. So for yourself, do you foresee more refinery projects being developed in the region despite the trend?
Well, if you look at, this is the oil demand evolution, you can clearly see that the sector that stays a little bit transition proof or transition supporting is the petrochemical sector. It is hard to decarbonize the aviation sector. It is hard to decarbonize the maritime sector. So what we are really witnessing is the demand side of the equation, which is mostly on the road transport sector. Now, in the road transport sector, EVs have certainly played its part, and China is the number one kind of the engine to drive the EV growth sort of in the market. So overall, I would say that the EV penetration might slow down because there is now competition between the BEVs, the battery, fully electric, and the plug-in hybrids, so and so. So there may be some elongation in the demand peaks that might take place. But more or less, OPEC Plus and the Middle Eastern knows that now the transition is irreversible. Now, in an irreversible transition sort of period, the best Middle Eastern system can do is to force closures of all other refineries across the globe, right? Middle Eastern refiners sit on the crude, they know the crude, they know the quality of the crude, they have designed the refiners very much to their crude diet, not like China or India, who have to design refineries for 5 times or 10 times of different crudes. Middle Eastern knows the crude, so they have designed better refineries, in my view. So with that in mind, I guess energy transition accelerates, no problem for Middle Eastern players. It simply means that the European or the Atlantic refining system will continuously come in the pressure because of the products coming out of the Middle East, and the Middle East refineries will still have a good, I would say, long era of operations despite the energy transition. And even in the base case scenario, we still need 60, 70 million barrels of crude oil. We still need to refine and service the demand even in 2050. So net zero doesn't mean everything has come down to zero. And I guess Middle East also has the lowest carbon footprint in terms of its carbon for the crude oil. So they have the crude oil advantage. They have the carbon advantage. They're investing a lot in the downstream to make it more compatible and synergize with energy transition, renewables. So I guess from all angles, Middle East, in my view, has nothing to fear or worry too much about the EVs. It is the other countries who have aged refineries who need to worry about.
Which in a way is what you were also indicating previously by saying that the simple refineries will anyway come under additional pressure and sort of start to, because the economics are just not going to work in that regard as well.
Correct.
Right. Back to you, Andy.
Yeah, thanks, Mukesh, for this. So while we are still on this topic, as more countries move toward energy transition, as you mentioned, where do you see the new home for the Middle East refined products?
Well, I would say that the homes, as you can see, demand in the chart, OECD world is still demand is going to be there. North America will not fall fast. There will still, Europe is, as you can see, still there is a quite good number of years to be there. The BRICS nations also have a number of years to there, and rest of the world, which is still developing economies. So I think one is not that the demand is falling off the cliff very soon. So the Middle Eastern refiners have, I would say, enough play at hand to recover the volumes and the margins, right? Number one. Now, Asia would remain the largest short for crude oil. Asia is also a big short for the products. A lot of the simple refineries in Asia will also close because revamping a refinery is going to become very costly than putting up a new refinery or starting up a fresh project. So in the past, we were doing a lot of revamps. In my view, those revamps will become meaningless. And that means that landlocked refineries in India and other places would have to think hard how they can sustain the operation. So that means the Middle Eastern refiners will have opportunities. Africa, we know Dangote, we talk a lot, but that's only one Dangote, and that's too big of a train to operate at the level at which it is needed to operate. So all in all, I guess Russian refining is in trouble. South American refining is in trouble. Canada is not big. US has the wrong crude oil under its feet for those refinery systems. So all in all, I guess Middle East refineries are in a very, very strong position.
Oh, that's very interesting. Thanks, Mukesh. Anyway, over to you, Aabha.
Thanks, Anjali. Thank you. Thanks, Mukesh. Very interesting indeed. We live in some very, very interesting times. I know there's this other slide on the EV sales evolution as well. Final thoughts. I know we've touched a lot and you've really explained things in detail, but in summary, if there were 3 key points that someone was to take away, today from this discussion, and looking at how the market is evolving with the whole tariff situation as well, what would those be?
So I would say that within the OPEC countries, it's a very diverse group. Some countries are increasing crude production. Some countries are not increasing crude production by diverting crude for the refinery systems. So there is a lot of diversity at play, number one. And what that means is that going forward, certainly product markets will become more dominant player in driving the crude market as we move towards energy transition. Now, in order for that to happen, few things need to really one is product storage. Crude market has big storages. That's why crude market is able to play a very international sort of a play, whereas the product markets, we don't have those big storages. So I know Fujairah and Dubai and Abu Dhabi are building a lot of big terminals and storage play. So product market storage play is one big thing to keep in mind. The second big thing to also keep in mind is that at some point of time, this is just my imagination, that if we can have an OPEC of crude oil in a declining demand world, will there be a time where OPEC members will sit down and also have a bit of an OPEC of the products market? It's a little bit a long shot. It's not easy, but I don't think that now it's out of the imagination. And I think the third thing to really focus is that the OPEC Plus has managed to keep the crude market in backwardated structure so that there is no storage play. If the demand, because of these tariffs and everything, sinks very much down, we still believe that the demand could turn out to be maybe 0.7, 0.8 million barrels per day growth. But if, let's say, imagine all of the demand growth is wiped out, then the product markets will go into contango, and that will bring the crude market into contango. So I think that's what OPEC Plus will be watching up. And well, they have the method, so they can easily curtail the product exports to support that market as well. So storage plays in products, maybe long short OPEC of products might be coming in some years time, and then trying to really balance the product market structure versus the crude market structure.
Great. Thanks, Mukesh, for that. Those were some very, very interesting thoughts and final thoughts as well. Thank you so much. With that, we've actually come to the end of our webinar at General Index. We would like to take this opportunity to thank Mukesh for his time and sharing his very valuable insights with us. Once again, the webinar has been recorded and will be made available for you to replay. For any further information on General Index, please email at info@generalindex.com, and a member of our team will be in touch with you. Thank you for joining us today.
Thank you, Aabha. Thank you, Andy. Bye-bye.